we go. And for those of you that just joined us, thanks so much for your patience. We will get kicked off right at the top of the hour. Oh, and hello to you, Todd Stout. Thank you for joining us from First Watch. Usually Todd is the one presenting the webinar, and I'm on the back end. So this is a really nice reversal. Okay. So I have right at 2 o'clock Eastern time, so we can go ahead and get started as people continue to trickle in. Thanks so much for joining us for today's ESOP in these turbulent times webinar featuring our expert, Phil DeDomenicis from Menke Associates. Phil has a storied history of helping other organizations to maximize their liquidity, engage their staff, and minimize their tax burden through setting up employee stock option plans. Phil has an MBA and has served as the East Coast partner at Menke Associates for the last 16 years. Previously, he served as Director of M&A, Mergers and Acquisitions for Solomon Smith Barney. He is a seasoned public speaker and serves on numerous boards. If we advance to the next slide, I'll tell you how to ask questions of Phil throughout the course of this presentation. So you'll notice on your screen, if you wiggle your mouse, you should have two options. The first is chat and the second is Q&A. Chat is the best place to put your informal greetings and comments to your fellow attendees. If you're having trouble hearing, please be sure to chat me by chatting all panelists in the chat box, and we will do our best to troubleshoot that. If you have a direct question for Phil himself, please use the Q&A function. It's the button with two dialog boxes at the bottom or top of your screen. That will put your questions in a queue to be answered formally either live during this broadcast or after the fact by our panelist, Phil. And with that, I turn today's presentation over to Phil. Phil, please take it away.
Yeah, thank you very much. Today's webinar will be an hour and hopefully some time for Q&A at the end. It is a pretty broad topic. When we do live seminars, they're 5 hours. So we're going to take a lot of materials, cram it into a small amount of time, which I apologize for, but the intent hopefully is to get some concepts out there that might be intriguing to you, and then to have a follow-up and get into much more detail of how an employee stock ownership plan might actually work for you. My firm has been around for 46 years, which is the length of the industry. My boss, John Menke, helped draft the original ESOP legislation. About 1 in 4 new ESOPs are created by us. And if you look at the bottom, our company is 70% owned by our own employee stock ownership plan. So I am a participant in our own plan. And so a lot of the concepts I'm going to walk you through today are ones that we're actually executing at our own company. There's currently about 11,000 privately held businesses with employee stock ownership plans. There's about 1,100 public companies. Today we're focused on the privately held businesses where a shareholder or shareholders are either looking for some liquidity or looking to exit the business entirely. When you look at liquidity options for privately held businesses, option 1, sell the business. Again, about 80% of new ESOPs, no one's looking to sell the business, they're just looking to get a little bit of money off the table, so it's not even an option they want to consider. But those that are considering selling the business, a little bit of a tough market right now. The mergers and acquisitions or M&A market tends to shut down in times of uncertainty, and the bank market shuts down first, and then the deal sponsors, and today isn't any different. And it usually takes a little bit of time for it to come back up again. So and what you see in these comments in red are really changes from 3 months ago. So 3 months ago, I'd be showing you these slides without the red comments, and now it's like the world's changed, at least temporarily. So where do we focus today? Number 2, sell shares from one partner to another. That's what a shareholder agreement is. Maybe it makes sense. A lot of people are looking to shy away from ownership since there was such a tumultuous market the last few months. Sell shares to managers. We put it on that because people always ask about it, but key employees tend not to have not nearly enough dollars to buy a business. Sell some shares to an ESOP. That's where we're going to focus today, or simply wait. There are times when the hiccup that the business is having is just a little too big. You need to focus on that, and maybe we really just need to be thinking about this next year. So what is an employee stock ownership plan? It's a retirement plan. So if you have a 401k with a match or a safe harbor contribution or a profit sharing contribution that's what an ESOP is. It's a retirement plan funded by the business. The business gets a tax deduction, the employees get a tax deferred account. Very similar. The difference is where does the money go? Instead of the money going to an employee's individual account, it goes to the ESOP trust. It's a separate legal entity that holds the assets for the benefit of your employees. But the investments are directed by the board of directors of the company, not the individuals. And an ESOP can buy your company's shares where the 401k cannot. So it's very typical that if you have a 401k that you keep it. It's also very typical that if you have a 401k match, profit sharing, safe harbor contribution, that budget line item stops going to the 401k and starts to go to the ESOP, meaning you're already paying for this program, you're just calling it the wrong thing. So why do business owners look at employee stock ownerships plan? Number one, it's liquidity. There's a lot of marketing brochures out there about selling your business to an ESOP, but the reality is most new ESOPs aren't selling the entire business to the ESOP. They're selling small pieces and just getting a little bit of diversification for the owner, starting a business succession strategy, trying to help the company's cash flow and trying to enhance employee productivity. Again, you see in red, you will see ESOPs being funded in downturns when other programs tend to stop, because somehow owners and boards look at ESOPs differently. We're all in this together, and thank you for helping us get through it. You don't have to, it's just kind of what you see out there. So they have been around for a long time. There's about 22,000 US businesses that have established ESOPs. There's currently about 11,000. A lot of the ones that are gone were sold to somebody else. So the ESOP is not in competition with sale of the business. It's just an option to it. So we have a lot of folks who sell a little bit of shares today with every intent of selling the entire business out in the future. We have a lot of companies that are 100% ESOP owned that sell the business to someone else just because it makes sense in the lifestyle. So you have an ESOP, it doesn't mean you can't sell the business. They're not either or. And then you'll see that ESOP businesses clearly outperform their comp group in good and bad times. There's a difference between being an owner and a renter. You own your car versus rent a car, own a home versus rent your home, own a business versus rent your business, meaning showing up as a worker. And what really is going on, I believe, is the definition of people's jobs change. My job as an investment banker is to educate people in ESOPs and find new clients. So my comp is very top line oriented. My job is not to worry about the expenses, meaning I wasn't hired to do that, but I do worry about the expenses. I do look at better ways to market the business. I do help out my brother and other 49 employees more. Why? Because I'm also compensated on the bottom line of the business through my employee stock ownership plan. So the M&A market in general is shut down. So a lot of things I'll say, they're not absolutes, they're in general, but the M&A market is currently closed down if you're thinking about getting liquidity today. The other issue is your stock price may be down, so it's hard to sell 100% today when you were just doing really well, and maybe in a year or two you'll be back up to that. ESOPs don't ask you to sell 100%. So I was talking to a gentleman this morning, his business is doing fine. He's not looking for liquidity for 20 years. He says, my accountant says I should sell the business. And I was like, well, then sell the business, but it's not for sale today. It's for sale 10 years from now. Establish the ESOP, get everyone pushing for getting that stock price as high as possible. But a lot of businesses aren't saleable in the first place. They're too small. There's not a logical buyer. The SBA finally came out with a study that said 80% of privately held businesses that are brought to market with an advisor aren't sold. Now, certain industries, and yours may be one of them, a little bit more easier to do. So I put, I talk to business owners all day. It's all I do. Business owners, CFOs, that's my clientele. As much as the news, clearly a lot of companies aren't doing well. There's really 4 categories of companies. There are ones that are doing better during this pandemic. There are ones that are doing about the same, and that's really a boatload of businesses where this isn't affecting them on their bottom line. There are some that are down but not out. That might be a lot of you guys. And then there's ones that are really struggling significantly. And we are talking to all 3 of the groups in red. They're calling us. They're still got to do a succession plan. They're still looking for liquidity. How we initially structure the ESOP might change a little bit, but still a very healthy market for us. This chart is to show, again, there's a lot of literature on selling your business to an ESOP, but the fact of the matter is, out of the 11,000 privately held businesses with employee stock ownership plans, 35% of them own a majority. And out of the 11,000, it's about 2,500 where the ESOP owns 100%. So the large majority, the ESOP owns less. Why? Because whoever the shareholders were when we found them didn't want to sell 100%. So a lot of them start out on the left-hand side and move to the right. A lot of them start all the way on the right-hand side. Others start somewhere in the middle. And that's the point I made earlier about these plans is they're very flexible. And what I always say, I need to make 3 people happy to have a successful ESOP. I need to make the shareholder happy, the company happy, and the employee happy. But I need to make the shareholder happy first. You own the business. You have a right to determine how you want to get value out for yourself. Sell the business is maybe one option, sell to another partner, sell to an ESOP, or some combination of all of those. So my job is to present an ESOP as one of those options if it makes sense. I'll tell you if it doesn't make sense, but also which flavor it makes sense. We also have a lot of family owned and operated businesses that also have an ESOP. W.L. Gore is the biggest example. It makes Gore-Tex. It's family owned and operated and controlled, but they have an ESOP that owns a minority of the shares for the benefit of all their employees. And that's a very typical thing for family owned groups. So there's 4 basic ESOP transactions. So again, part 1, it's a retirement plan funded by the business. Part 2 is it buys shares from shareholders, or it gets shares from Treasury. Well, which one of these options do you pick? I don't know right now. I need to talk to my prospects, the shareholders. Who are you? What are you trying to do? What's your timeline? The gentleman I just got off the phone with, he's going to be around for 20 years. He's not eager to sell 100% of the business. We'll probably do step 4, contribute a little bit of shares, and then we'll see where it goes. But option 1, contribute cash, like if you have a 401k match, profit sharing. Put the money in the ESOP instead. Now it's sitting there. And at some point in the future, sell some of your shares to that ESOP. You take the cash, it gets the shares at whatever the fair market value is on any given day. Very simple process. Option 2, and we're seeing a lot of this in the down market, is contribute shares directly to the ESOP. So this is interesting. You can, if there's 100 shares outstanding, contribute 1 treasury share. So now there's 101 shares outstanding. So the current shareholder base owns less shares, but it's a non-cash item. You get a real tax deduction for doing it. Your cash flow goes up. That might be interesting in a year like this year. Or borrow cash, and buy stock from a shareholder, meaning a leveraged ESOP. You want to sell 20, 30, 40, 100% of the business, then we need to look at a leveraged ESOP. And then option 4 for our existing clients that have an ESOP, that have some cash sitting in there and they're looking for cash in these tough times, well, the ESOP can buy shares. In option 1, it buys it from the shareholder. But in option 4, if the cash is already sitting there, it can buy shares out of treasury, just like a private equity financing. So I'm going to get into a little detail, so bear with me. But if you put your hand over the left side of the screen, on the right hand of the screen essentially is a 401k match, 401k safe harbor, profit sharing plan. The company's making a contribution on an annual basis. And in return, it gets a retirement plan for its employees and gets a tax deduction. But if those dollars, instead of going to a 401k, goes to an ESOP, the ESOP can buy shares. So cash goes in first instead of the individual employee deciding how it's invested. The board of directors makes the decision, and the board of directors decides to use it to buy some shares from one of the shareholders. Yes, this is why we set it up in the first place. And then you'll notice step 1 and step 2, sometimes they happen on the same day, and sometimes they happen years and years apart. So it's important to understand the mechanism to have an ESOP is not that it has shares in there. The mechanism to have an ESOP is you set one up and you funded it. And there's a benefit. And the employee has value, and it can be cash, it can be other investments, and it can also be your shares. It's just one of the investments. Same thing like a 401k. You can own lots of different investments, just not your company shares. And the ESOP can own all those investments and your company shares. Structure number 2, and again, might be more, there's probably going to be more popular. It was definitely more popular in the downturn last time, and from what I can see so far, more popular this year as well, mainly because I promote them because I think they make sense, is, hey, we're doing okay, but if we had more cash, that would help. So it's maybe contribute some stock to a retirement plan this year. And it's real value to the employee, a real tax deduction, but it was a non-cash item, it's company stock, and you pay less taxes, meaning your cash flow goes up. And you're encouraging your employees at the same time to start to behave like owners, meaning really focus on driving profits, be efficient, work hard, etc. Structure number 3 is a leveraged ESOP, and there's 2 different ways to do a leveraged ESOP. One is you borrow money from a bank, and you see the red question mark there, which is, hey, the banks have kind of shuttered their doors a little bit, not completely, but certainly more than 3 months ago. They're also focused on all these PPP loans, so even if you're a good credit, they have been distracted. But they tend to shut down the M&A market, and it shuts down the bank financed leverage deals a little bit currently. But in this case, you can, if you're looking to sell 20% of the business, maybe a bank lends the money and the selling shareholders get an entire check. What is very popular in ESOP world, which is instead of going to the bank and asking for money, you sell shares and you take back a note, which may sound a little bit weird, but if you have a shareholder agreement, that's essentially what happens when one of the partners retires. Is they retire, you figure out a price, and then you pay them out over the next 5 years. Exact same concept. And in ESOPs, these are used all the time. And a lot of times that selling shareholder is still running the business. So they haven't gone anywhere. They're just not waiting for their day of departure. And that's another important thing, which is if you have more than one shareholder and have shareholder agreements are not a succession plan. They are, if we didn't talk about this ahead of time and somebody leaves, what do? We dust it off and say, here's what we agreed to 10, 20, 30 years ago. But it's not a succession plan. You're allowed to do things well before that day. And frankly, I encourage you to think about that. So some typical ESOP scenarios. You have a shareholder or all your shareholders, they're just not ready to sell shares. And this might be one of those years where you go, even if I don't even want to sell a small amount of shares, it's just a tough year. I know next year should be better. The stock price will bounce right back up. It's just not the year to sell shares. It doesn't mean you don't set up an ESOP and fund one. You're allowed to, if you're put a profit sharing contribution in after the year is over to thank people for helping you get through the year, then the cash is sitting there waiting for you to want to sell some shares. And I had one client we call it pre-funding, but pre-funding the ESOP for 14 years. They put cash in it every year. The employees were earning it. The company was getting tax deductions. It had replaced the 401k match. So he wasn't spending any more money than he was expecting to do anyway. And then 14 years later, after I set up his ESOP in 2005, 70% of the value of the company was sitting in his ESOP, meaning it didn't cost him a nickel. It was money he would have already spent. Objective number 2, shareholders not going anywhere. But you like the concept, you like employees having some equity in some form or fashion, because then they'll help drive the value and you own the majority of it. So what I want you to do is think about, what should this look like for the next 10 years? Now, we're not putting it in ink, we're just saying, sketch it out. And every year it's going to change, but I want to start and maybe sell 5%. Sell a small amount, then maybe 4 years from now when the stock price is higher, hopefully, you sell a bigger chunk. But also at that time, you're thinking about, well, that's about the time I want to slow down at the business, buy a boat, not work on Friday. So I want to get some money away from the business and into a different pocket. And that's one of the nice things about the ESOPs, which is it doesn't come with people. So it really gives the shareholder group, if you're an owner operator, a lot of flexibility when you look at your succession plan. Your succession plan is shares, board of directors, officership, which if you're the 100% owner operator, you look at it all the same, but it's really 3 different hats. And you can't give up control of the business when you own the whole thing. It's not natural to do that. But if you own 70% of the business, or 30%, like my company, John Menke started his ESOP 30 years ago. He now owns 30% of the business, not 100. He's still our CEO, but he's brought on others. You can see he's kind of given some major tasks. We finally hired a CFO 5 years ago, so he doesn't do that work anymore. He's still very active, but I think he takes Fridays off. Well, part of it is he wants to, but the other part is he can afford to do that. He has other senior managers helping him. It all used to be him. Now he has others. And he can relax a little bit, but he's still the chairman of the board. And that's the other nice thing is, as you peel away from the business, we still need people to help run it. And we have a lot of our ex-owners who don't want to do day-to-day anymore, still at the chairman of the board, which is kind of a fun place. We also have others who go backwards. They go down the corporate ladder to where they used to be. I had one guy, he's a chef. Then he ran a business. He wasn't a chef. Now he's back to being a chef. Another guy going back to selling cars. Another guy went back to research. So they're going back to things they enjoy, but you can't do that if you still own the business, because you still got to be the CEO in general. Objective number 3, I have 2 shareholders, and one's a 70%, one's a 30%, and they want to sell on a pro rata basis. They both want to sell a little bit. And the point of this slide is, if you want the ESOP to buy 30%, if you have 10, 100, 1,000 employees, you've only added 1 new shareholder. The ESOP is one entity, it's one shareholder, and your employees are beneficiaries. They have a right to the value of what's in there that's been allocated to them, but they don't technically own the shares, and that's a very important distinction. One said we just want to take care of the minority shareholders. So my example was a 75% majority and a 25% owner. Well, this is a lovely way to do it. So if you recall the options to succession plan, sell the business. Well, selling the business isn't even on the table. Why? Because the majority owner isn't going anywhere. We're just trying to take care of a small shareholder. Well, option one is the majority can buy the shares. Option two is the company can buy the shares. Option three, the ESOP can buy the shares. Oh, the ESOP comes with many, many more tax benefits, but it doesn't mean you don't take a serious look at one of the other options, or a little bit of both. Objective number 4 is you want to sell 100% of the business. Well, if you come to me today and say, Phil, I want to sell my business, it's worth $10 million, and I want all cash. I'll say, please go try to sell your business to somebody else, because the ESOP doesn't have $10 million of cash, nor will a bank lend 100% of the value of the business. But I do want to point out, in at least this example, some examples. Option one is you sell the entire business to the ESOP. In my example, $10 million, and you take back a note for at least a good chunk of it, and maybe some bank financing. And then we pay you out into the future. This looks weird. If I were selling your business to a third party and they came in and said, Phil, we'd like to buy your client, but will they take back a note for the whole thing? I wouldn't show you the offer. That's weird that a third party buyer wouldn't pay something. But in ESOP world, this is done all the time for a few reasons. I think at the top of the list is, well, the person who just sold to the ESOP is still running the business. You're still in charge. So you're helping pay back yourself. Reason number 2 is 100% ESOP owned S Corps, which we haven't talked about yet, don't pay corporate taxes anymore, which is huge. Earlier on, I said out of the 11,000 privately held businesses, about 2,500 of them, the ESOP owns 100%. They are almost exclusively S corporations. Well, S corporations pay corporate taxes at the shareholder level, while ESOP trusts are tax exempt. So there is a K1. So a lot of ESOP stuff is go back to what you already know. Accounting's the same. Corporate governance is the same. S Corp and C Corp taxes are the same, but an S Corp owned by a tax exempt entity doesn't pay taxes. So it keeps all its cash flow. Well, what are we going to use it to help pay you back? Option number 3, and the seller also participates in his or her new ESOP, which can be very generous over time. And the employees are the beneficiaries, and the company's still independent, and there's about 12 different things, but those are the reasons why you might seriously consider something like this. Now, this might be an example of, well, this is what I want to do, Phil, but 2020 financials are a little bit off for obvious reasons. Okay, so maybe we plan for this. Maybe we go back to option 1 and go, well, let's start it up and put a little cash in. Maybe at least a year, maybe 2 years, but clearly the intent is at some point when you feel the value is good, we then flip to this option as well. So all these options are kind of pick and choose. Option number, second option, yes, Amanda. Oh, I can't hear you.
Oh, there we go. So we received a question that I think ties into what you're talking about here. And I just want to make sure everyone on the line is super clear. Someone asked, my family owns an ambulance service outright. We don't have shareholders or stock already. Is it possible to set up an ESOP to sell some of the business to our employees?
So the answer is definitely. If they don't have shareholders or stock, then it means they're probably an LLC. Or an LLC or an LP, which would be converted to a C Corp or an S Corp where you would have stock. So you do have to be an S Corp or a C Corp, but we have lots of LLC plus or minuses that do ESOPs, but you simply need to convert to one, which usually is not that big of a deal.
Wonderful. And coming in from the chat right now, is there any model where a 501c4 or C3 not-for-profit could create an ESOP, or is this just for for-profit entities?
Not-for-profits can do ESOPs. There's not a lot of them, maybe for others, but yes, a not-for-profit can do ESOPs, and we've done some, and contact me after and we'll walk you through how that works.
Wonderful. And just
go ahead.
One last quick one while we're having a question break here. We have many dedicated employees for many years, but haven't been able to pay them very much because of low reimbursement, so they don't have money to purchase from us. Is there still a way for us to do this?
Well, yes, and the employees aren't writing checks. It's a profit sharing plan. So the money does come from the company if you had a 401k match or a profit sharing, kind of the same concept. If you haven't been doing any of those, then this would be more, at least initially, but there are ways that essentially the government kicks in later to pay for it all, which gets into a little bit of detail. But the intent is that the tax savings pays for the shares over time to the benefit of the employees.
Thank you so much for clearing that up. And with that, please go ahead and I will hold all other questions to the end.
Okay. So in this slide, we're looking at selling 100%, but we're going to do it in stages. We're going to sell about a third today, a third 4 years from now, a third 7 years from now. Why might you want to do that? There's more tax savings if you sell the whole thing, but this is because the shareholder doesn't want to sell the whole thing today, and you have every right not to. And a reason for that, the most obvious reason, is you think there's great upside in the stock of the business, and you simply don't want to sell shares today, or a lot of shares. So we do it in pieces over time. This is a 3-stage, but it could be 2-stage, 10-stage, 30, like it's just, you're selling in pieces over time. It's simply an example, but the thought here is that you're getting the benefit as the shareholder of an ever increasing stock price. Enhance your benefits package. I like 401ks. I don't sell them, but I like them for employees putting their money into their 401k. When you look at the company side of if you're funding a 401k, matches don't add to productivity because they don't have anything to do with productivity. 401k profit sharing plans have been shown to move the needle on productivity if you heavily promote it. And ESOPs move the needle even more because there is a difference between equity, which is long-term profits, and profit sharing, which is this year's profits. Things like protect the name on the front door, meaning the reputation of the firm. That's how you keep business and get more business, etc. Be safe, do everything right the first time, things like that, which is the reputation of the firm matters. I'm just picking an example. Well, but you pay me by the hour. Well, that's fine, but I also pay you for the long-term value of the business. These things should also, over time, help lower turnover. Why? Because now they have a vested interest in the business and they're getting a piece of the dividends that come out each year. And that's, another thing, which is I've been talking about contributions, but once the employee has shares attached to them, if there's a distribution or dividend check, well, they get that as well in proportion to the shares they own. So I've been at Menke for 16 years. I've been in their ESOP for 16 years. I've had lots of shares attached to me. And when there's a dividend check, I get all those shares times the dividend amount. Now we just hired a new investment banker in Chicago. So he might get a similar contribution this year from me, but the dividend check, he won't get any. Why? Because he hasn't been in the program yet, and therefore he hasn't accumulated any shares. And we're the largest ESOP administrator. We administer about 1,000 plans, and we get to see all the data. Well, there are participants in plans whose dividend check is larger than their paycheck. Well, that person, why? Because they've been in the ESOP's been around for a while. They've gotten a lot of shares attached to them. The company's still profitable. They're paying out dividends. Well, they get a big dividend check. That is an employee who should never leave the firm. Why? Because they would lose that benefit. And you're not paying them out of cash. You're not paying. That's not coming from your P&L. It's just their plan has accumulated some company shares over time. And then this year you'll see in the red, which is, most 401k matches were decided on last year for this year, and then it's hard to get out of them, and times are tough, and geez, I already committed to that. So at minimum, I like 401k profit sharing plans. You get to wait till the year is over to see if you can afford it, and then it goes to all employees who are full-time, and then you connect the dots and say, we had a good year and we're giving you a little bit of extra. Now, the shareholders, why would you do that? You do it because you think you're creating a more productive workforce and that the return to you as the shareholder is more. That's why you would do that. So objective number 7, you're trying to increase cash flow this year. So that was that second structure that I pointed out, was issue new shares or treasury shares directly to the ESOP. So this is not creating any liquidity for the shareholders today. We're diluting the shareholders a little bit. Why? Because we're going to increase company cash flow to keep us afloat or to make us more competitive or keep our employees together, because they're all good employees we like, and we just got to get through this time. And once we do that, then we'll be well situated to compete with everybody, maybe better. You get the tax deduction for it. And the nice thing is the CARES Act kind of reenacted net operating losses. So even if you're not profitable this year, you contribute shares to the ESOP, and then you go back to last year's taxes and get the money back from that. So it's a really interesting mechanism to get cash flow higher if that's one of your priorities at this point. And again, lots of concepts that I'm throwing at you very fast because there's lots of concepts and I have an hour, but the hope is if there's something in here that's intriguing to you, simply reach out and we'll get into it in more detail. So S Corp ESOPs have been around since 1996, although ESOPs have been around since 1974, so a relatively newer concept. And here's the biggest benefit of an S Corp and an ESOP. S corporations pay taxes at the shareholder level. So if one of your shareholders, in this case the ESOP, owns, in my example, 30% of the company for the year, well, ESOP trusts do not pay taxes. So if you do send a distribution to your shareholders to pay taxes, typically on the left side, the ESOP will also get a distribution because it's a shareholder, but it doesn't flow through to Uncle Sam. So this company, last year was owned by individuals. This year it's owned also by the ESOP. This year, the government, the federal government, and in 48 states, the state government will collect less taxes from you. And it sits in the ESOP trust. Now, if the ESOP just bought these shares 30%, then it borrowed the money, either from a bank or a seller note. And guess what we use 30% of the tax bill for? To pay for the shares. So in more cases than not, when you're setting up the ESOP, this is not costing the shareholder more money to pay your employees more. The government is chipping in. Why would they do that? They do that because it creates more productive companies. It creates more stable businesses. It prevents businesses from being sold to third parties outside the country. Not your industry, that can't go outside the country. But it's keeping the tax base here, and the tax base is actually profitable and pays taxes. Last year, actually 2018, the government subsidies to ESOP community was $2 billion. But it made $8 billion from ESOP companies. Well, who was that? Well, right now there's $1.4 trillion in ESOP accounts. It's 11% of the US adult workforce has an ESOP. About half the US workforce have a 401k or some sort of retirement plan, and 11% also have an ESOP. And there's $1.4 trillion in there, which is about a quarter of the 401k market asset value. It's huge. And there's a lot of retirees, and they're leaving the system, and they're finally paying tax, ordinary income, on one of their retirement accounts, the ESOP, to the tune of $8 billion. So the government likes this. It actually works. They did something right. If by chance you go to 100% ESOP owned S Corp, nothing says you have to. You don't have to keep selling shares. But if you do make it to 100%, we will want you to be an S Corp. Why? Because now you're one shareholder of an S corporation. Doesn't have a shareholder saying, give me some money, I got to pay the government. They don't pay the government. So now all the pre-tax income of this business stays in the business. Clearly, if I were a manager of one of these businesses, that's where I'd want to be. There's simply more cash for me to do my job. I can make more mistakes and still look better. I can bid contracts a little bit lower. I can build my workforce quicker. I can go after more contracts. Why? I have more cash than I did the day before. And I certainly have more margin than my competition. C Corporation ESOPs. You don't get the tax benefit from the S Corp, but if you're a C Corporation and you sell at least 30% or more, you can defer capital gains and maybe never pay capital gains. So it's a nice thing that Congress has allowed for this. I don't want to get a whole lot of detail, but it is something that you read a lot about. It's a nice thing. It's actually not used in the majority of the cases, so don't get too stuck on it. But if it makes sense for your shareholder group, we will be explaining it to you. ESOP appraisals. You will hear out there, I heard on the last call, my CPA said selling to an ESOP is lower than selling to a third party. Maybe, maybe not. I got lots of clients who tried to sell their business and got zero bids. So, and the ESOP pays a fair market value as a financial buyer. So more often than not, it's actually higher than a third party buyer. There's a fallacy out there that, you can just go sell your business. Again, some industries are a little bit better than others, or easier to sell. But timing matters, and who your company is and where you're located. And are you adjacent to somebody else that really wants to bring you in, etc. I'm sure you've heard all of this. The ESOP valuation is done by an independent appraiser, since there is no third-party buyer. It's not a financial buyer. It's not your competition trying to write you a check. But I don't mind you talking to them. There's a way to look under that rock while looking under the ESOP rock to decide which one makes the most sense for your shareholder group. And then remember, in about 80% of the cases, you're not looking to sell 100% today, so it's not even an option. But the ESOP's intent is to pay the fair market price, which is what a financial buyer will pay, meaning a leveraged buyout shop or a private equity firm, because that's what the ESOP is. It's a financial buyer. It does not come with synergies. You've heard me say this a few times, but I'm not against selling to a third party. I want to compare it to that. There's a way to look under both rocks and be efficient and not go spend 9 to 12 months trying to sell it, come up empty, and then come to us. There's a way to make that other process much shorter if it's not really playing out. Financing leverage ESOPs. ESOPs have been around for 46 years. There's a mature market. Banks like to lend to ESOP companies because they tend to do better. Your loan officer may not have seen one. Your CPA might not have seen one. Your local counsel may not have seen one. They know a little bit about it. My job is to teach all of them and to debate them. If they don't think it's good, I want to know, what are they thinking? And a lot of times what they're saying is correct, but it's why we're doing it a different way. So I want all your advisors happy. And the bank, again, it's a little bit of a wonky market right now because for obvious reasons. In times of uncertainties, banks tend to hide under a rock, and it usually takes them a little bit of time to come out. But I am working on bank finance leverage deals as we speak. So I didn't close completely, but I'm not trying to sell 100% of the business with 4 times cash flow senior lending. I'm trying to sell 20% of a business where the senior financing is actually pretty nice. Again, seller financing is very flexible, and one of the things I forgot to say of why you pick seller financing is the third bullet point is there's a really nice return on the seller financing, and more often than not, the return on your seller note is a higher return than if you kept the shares. If your company's growing at 5% a year, in general, your stock price grows at 5% a year. Well, maybe you get a 7 or 8% interest rate on your seller note. So it actually makes sense to get out of your equity and into the debt of the business because it pays a higher return. So what do the employees experience? 14.1 million participants. A lot of people have ESOPs, but it's still the minority in the US. The second bullet point, if you just look at all ESOP accounts currently, an ESOP participant has 4.5 times the retirement funds of everybody else in this country who's a working adult. This number 16 years ago was 2 times. It's growing. That's a huge multiple. If you look at the 60 to 64-year-olds, this is a new study. The 60 to 64-year-olds currently with an ESOP account have 10 times the retirement funds of their counterparts. That's huge. Why? It's a forced savings plan, and the investment tends to do a heck of a lot better than the market in general. So I like the statistics. And then you'll see that ESOP companies, meaning their accounts, also actually do better through downturns because the companies are more responsive, there's more productive, they tend to have more cash on the balance sheet, they tend to do better. And they tend to be laid off a heck of a lot less. In the last downturn, the average company in the US laid off 12% of its workforce. The average ESOP company, 3%. It's 4 times less. Big multiples. So to the employee, and this is one of the slides I showed, I think the last slide I show your employees, if you set up an ESOP, we also explain it to them. Take care of your company. Not my company, your company. This is your company. Well, it's already a place where they work and they like their job. So accountability to the company and accountability to the client, of course, they're focused on that because that's their job description. Accountability to each other, that's a little bit different. We're all in this together. Someone has a problem, you're more likely to help them out. Well, I'm not going to pay you for that. Yeah, but you get paid through we're a better business. And then accountability to yourself, and that's a grown-up conversation, and we do put out some stats to your employees about retirement planning and Social Security. And the point is please focus on your retirement. Your company now offers typically 2 retirement plans. Please use your 401k. I beg them to do that, even though it's not my plan. Please focus on what the ESOP is and how it works, because it's in your best interest to understand these plans, period. So I gently push it back on them to learn about retirement planning if they haven't already done so. And then the last bullet point is loyalty. We simply want you working here. You have options. We think we're a better company. We think we treat our employees better. We think we pay you better. We think over time you're going to do much better with all our benefits, including the ESOP. And we really want you working here, but we need you understanding how we pay you in the total package, not just your hourly rate, which people tend to focus on. Nope, please explain the whole thing and how well you pay them, and then they're less likely to leave. So how the employees get in, this looks like a 401k match or profit sharing. They're eligible, 1,000 hours or more in the last day of the year, typically. The company makes a contribution. The company may pay dividends. They get the benefit of both of those. There's a vesting schedule, just like a 401k match. And then they eventually get their money after they have left their business. All the same mechanisms that any retirement plan has, qualified plan, because that's what the ESOP is. It's a qualified plan under ERISA. It's just a different flavor of one. This is what you owe the employees. You essentially owe them the statement of their account each year. You do not owe them company financials. Why? They are not shareholders. They are beneficiaries to a trust. Now, I encourage you to share some matrix with them of the financials during the year, but you don't have to. Hands down, lots of studies, ESOP companies do better. They're less likely to fail in times like this. They tend to outperform. The employees tend to be better off. Management tends to be better off. The shareholders tend to be better off. The community tends to be better off. ESOP companies disproportionately show up on lists like this. They're only 11% of the workforce, but they're 20% of the Forbes most trustworthy companies. They're 40% of Inc.'s best workplaces. Why is that? Why? Because we're treating the employees, I compare it to Thanksgiving dinner. They're all now at the adult table. The conversations change. We're not asking them to run the business. We're asking them for their ideas. How can we run this place better? It's more interesting to a lot of people. They feel more valued. So next steps, one is just call me. You know, if you're intrigued, call me, reach out. You'll learn more. I need to learn a little bit about you and who you're about, and does it even make sense for you given your other options? And if it does, then we'll start walking through the process of structure is number one, setting up your ESOP is number two, funding it is number three, and doing a transaction is number four. And now sometimes these all happen very close together, and sometimes they happen spread out over many, many years. So it just depends on who you are and what you're trying to do. My company, we call ourselves sell-side advisors. We're ERISA lawyers, investment bankers, record keepers, and a bunch of other things, all ESOP centric. We work for the shareholder in the company to set up the ESOP, run the transaction, and then upkeep the plan. We currently maintain about 1,000 ESOPs. We're by far the largest. And here's my contact information. If you're intrigued, please reach out. And Amanda, if I got you 10 minutes, so hopefully that's good. Ask any questions that may have come in.
I think the timing is going to be perfect here. So first of all, Phil, thank you so much for going through that. I think we've got a bunch of questions. One is, when an ESOP is established, can the vesting be retroactive? For example, employee owners who have been with the company for 6+ years are vested on day one of the ESOP?
The answer is yes. So what Congress has done is they're like, here's the parameters of how you can design your plan. And the way I say it is, here's the worst you can treat them, but you can always be nicer. So you might have a 6-year vesting schedule, but say, we're just starting day one, January 1, 2020, we will include time served. Great. So if you've been here for 10 years, you're fully vested, or 1 year for every 3 years you've been with the business, but you can always be more generous. Yes.
Thank you so much for that. Could we sell 100% of our business, but stay on ourselves as employee owners? If so, could we maintain a higher percentage of ownership ourselves?
Yes and no. So the ESOP doesn't come with people. So more often than not, whoever the owner operator is staying on for a period of time, and that period of time is dictated by them. And again, this morning I was talking to him, he wants to be around for 20 years. One of the first deals I did was a 42-year-old owned an IT business, sold the whole thing to the ESOP. He's still there. He ran it for, this was 2006. So for about 10 years, he was still the CEO. Now he's the chairman of the board. He hasn't gone anywhere. Because he's valuable and he doesn't want to go anywhere. So the ESOP doesn't kick anybody out. It's the opposite, is you get to stay. The second question is, can you get more? The allocations typically are in proportion to pay. So you're probably one of the higher paid people, and therefore you would get more, but you got to follow the formula within the ESOP. That being said, about 1/3 of our clients have a second equity-like plan for key employees, which is a pick and choose plan. So if it makes sense, there are times when we go past the ESOP to get a higher concentration.
Thank you so much for that information. Another question is, does an ESOP setup change any employment decisions? Can you furlough or fire employee owners if you have to?
Absolutely. It's not a union. I've worked with union companies. There's no, like, you can't, you do exactly what you're doing the day before.
Wonderful, thank you. I've heard that ongoing costs of ESOP administration are very high. What's your estimate, or can you shed any light on that?
Sure. Usually that's not a correct statement. They are higher than a 401k because there's an appraisal done each year. In general, what we charge is $4,000 plus $40 for each of your first 100 employees. Then it drops to 30, then it drops to 10. So if you have 100 employees, it's $8,000. So that's the number for that amount. And if it's 50 employees, it's $6,000. The appraisal for a $10 million or smaller business on an annual basis may be $10,000 to $12,000. So we'll gross it up. 20,000 grand or less to maintain it. Clearly more than a 401k. For a company with 10 employees, your statement might be correct. For a company with 50 employees, usually it's a rounding error and it doesn't matter. But also the retirement plan can be the expense. It's not a corporate expense. So if the ESOP owns 100%, well, first of all, you don't pay taxes anymore. So this clearly is a rounding error. So it is real money, but usually that statement that it costs a lot, once people actually see the number and how it's paid, go, oh, that's not an issue.
Thank you so much for that. Next question is, I would love to hear your perspective on the Baster Institute at UCSD, University of California, San Diego, if you have time, please.
They're an organization that we sponsor. They are supposed to be someone who gets the information out there to educate folks. Although in order to make money, they've started to compete with their people who donate to them by doing these feasibility studies. So, in general, I like the information side of what they do, which is help spread the word and help business owners get there, and they're fine. But as far as like what structure makes sense for you, 25% of all deals go through us and none go through them. So we probably know a little bit more. I hope that was politically correct.
We'll strike it from the record if not. And I think we've got time for one. We've got one last question here. Can you talk a little bit more about how you help value a business, especially in the face of COVID-19? I think what they're referring to is that many ambulance organizations across the country have experienced extreme economic hardship that might be limited just to this year or just to these past few couple of months, even if they were doing okay before.
Right, a great question. So the nice thing about my industry is there's, I don't know, a dozen big advisors and then a second tier, and we all share notes because at the end of the day, we're trying to all do good deals and not get in the crosshairs of the Department of Labor. So when it comes to appraising businesses in times like this, well, if you recall, when they first started all this, they kept talking about a recession. And this is not a recession. This is the government turned off the spigot and then they're turning it back on again. But although the economic data was recession, it's not really what was going on. So in the last recession, you got to figure out, well, if you're trying to sell some shares today, how long is it going to take you to come out? How does that work, et cetera? Where the ESOP appraisal community is coming out, and I think rightfully so, is this is a hiccup, meaning it's an extraordinary item. So they turn the spigot off, they turn the spigot back on. We have lots of industries that are actually doing better right now. Their appraisal values are up. If you're one that was hurt by the pandemic, but not a restaurant, you're really down and out. And I talked to one this morning where you go, look, you're fine, but you're down. Well, first of all, if you have the luxury time, don't sell 100%, even if you do it next year because you've been hurt by a little bit. But by the time you get this up and running and do a sale, maybe January 1 of 2021, we'll know whether you're out of this or not. We'll have much more data. But where the appraisers are going to come out, it appears, and I've already seen it on a few, is they're going to kind of ignore the downturn. They're going to look at your last 5 years. They're going to look at this as an anomaly. They're going to assume that 2021 is about the same as what you were doing historically, or maybe a little bit light, but if you had kind of this V shape down and back up, they're in general going to ignore it. So that's good news, but I also think it makes sense because what stock price is the future. Where are you, where you're going, how much cash flow can you kick off? And it's no different than if y'all just close the doors for 3 months and then open them back up again, which is the 3 months is not a reflection of the future.
I think
and that is one of the reasons
helpful.
why we want to do this webinar at this time, which is to go, look, this market has not closed. The M&A market might have closed a little bit, and maybe this is an option, or maybe that was, but we're still open and doing deals.
Wonderful. We have one last question. It's 2:59, so we're going to get it in under the wire.
Okay.
I'm curious about the cost to set up an ESOP initially.
Sure. So there's four, great question, and you saw the 4 steps, so maybe I'll back up to it. Step 1, does it even make sense for you? We do a lot of free upfront work of just who are you, what are you trying to do? There's these things out there called feasibility studies that people charge really just to educate you. We don't have to charge it because we get paid for the rest. So I'd say 1 out of 10 new clients, I'm actually getting paid to give you advice. And it usually some weird situations that require a lot of modeling. So if I need to open them an Excel spreadsheet, I'm going to charge it. But more often than not, we don't need to do that to get to here's a structure that makes sense for you. You may want to go out, though, as part of the feasibility and go, well, if I sell to an ESOP, what's the price? So in step 4, you got to hire an appraiser. Well, in step 1, the trust hires the appraiser. In step 1 is the company hires a different appraiser who typically works for the trust who's going to help us figure that out. So instead of me as an investment banker, you hire them. That could be a $10,000 to $15,000 cost if you do it. Step 2, design the entire ESOP, which is eligibility, vesting schedules, do all the documentation, get IRS approval, set up the trust, get the tax ID number, and communicate with your employees. I think we're the only ones who do that. We charge a flat $25,000. Step 2. Step 3, make the annual contribution. That's just whatever amount you're putting in. Step 4, sell shares to the ESOP. If you're contributing shares, you got to pay for the appraiser, maybe 15 grand. If you're selling 10% of the shares, it's maybe 60 grand to hire someone like us and an appraiser to help you through that. If you're selling 100%, depending on the size and the complexity of the deal, that could be $150,000 to $300,000 cost. That's kind of the kitchen sink of ESOPs, is selling the whole thing. So step 4 is a broad range depending on what you're trying to accomplish. And I got 302.
Well, thank you again for your time and insights today, Phil. Do you mind going back to the slide that has your email address on it? I've also put this in the chat box. The amount of information and the quality of the information that you shared today is something that I think is tremendously helpful for our members, whether they move forward with these projects or not. So we truly appreciate all of your time and thought today, and we can't wait to hear about many future successful EMS ESOP programs.
Thank you, everyone, for participating. I appreciate the opportunity, Amanda.